everybody. Welcome back to another episode of VCTV, the Venture Capital TV. So, my name is Sonny Mohanty. My name is Sonny Mohanty. I'm the host and the moderator of the show. There are some technical difficulties, if I understand correctly. Apologies, I don't know what's happening. I'm just using my normal speaker, a mic. Welcome back to LATOKEN's VCTV. I'm the show moderator and host today. And today, we're going to discuss about early stage venture and seed investments. Can I request everybody to put themselves on mute, please, just to ensure that it's just not double sort of echoing. I think it's gone. Thank you so much. Thank you so much for putting yourself on mute, and welcome back. Welcome back. And we are joined here today by speakers who are investors, but some of them are going to put on their entrepreneur hat to discuss this topic on early stage venture and seed investments. Let's have a quick round of introduction. I'm going to start with Dr. Maren in Singapore. Hi, Dr. Maren, how are you?
Hello to everybody. I'm very fine. Well, let me introduce myself quickly. I'm spearheading Schweizer World. We are a family office and Schweizer's venture engine and capital arm here in Singapore. We've been investing into 34 digital ecosystems over the last 4 years. My academic background is actually engineering, and I hold a PhD in economics. I like sailing, I like diving, and snowboarding too. So happy to be on the show with you today.
Thank you, Dr. Maren, and welcome back on VCTV. Next we have Dr. Gary. Hi, Gary.
Hello, everybody. My name is Gary Fowler. Great to see some friendly faces. Dr. Maren Schweizer, yourself, Sonny. My name is Gary Fowler. I'm a serial entrepreneur and investor. I've done 17 companies, written 160 articles over the last 14 months in artificial intelligence, quantum computing, entrepreneurship. Love AI. AI is the new electricity. I've done 2 unicorns and Click Software, which was sold to Salesforce for $1.35 billion, and also Eva.ai. It's been so long since I said them, you know.
Yes.
At AIHR Tech Company, and I'm the CEO, president, co-founder of GST Get Shit Done Venture Studios, a premier AI and quantum venture studio and accelerator located in Silicon Valley. Great to be here. Great to see some friends.
Thank you so much, Gary, and welcome back. All right. Next we have Dr. Srikant. Hi.
Hi, am I audible? I know I'm visible, but am I audible? I believe there's no echo per se. Hi, I am a legal counsel, and I act as a counsel for the Forbes 500. And Gary, I may be participating in some of the IPOs that you are dealing with. So probably the S1s that you were talking about should be directed towards me as well, if you have something. So what I'm trying to say over here is we invest in a lot of companies, and it so happens that as a counsel, it hits my inbox a little earlier than it hits the I would say anyone else's inbox, because of the fact that the promoter just forwards it, and on the forward button the default is generally me. So I take a look and I say a yay or a nay. So I'll give you a perspective in terms of, especially in seed, there's a lot of interest, which is that there's a lot of interest / inquisitiveness that is there amongst the family owned businesses. So let me give you that particular perspective. Nice to see familiar faces, Gary, after a long time, I believe. And Dr. Schweizer, welcome. And thanks, Sonny. Over to you.
Perfect. Great. I think we have a great panel today to discuss about early stage venture and seed investments. So why are we discussing this topic? I think we all are a part of the ecosystem. Like, we all work with startups, we invest into them, or sometimes we are in the board, sort of members in the startup. So a startup with a brilliant business idea is aiming to get it operations up and running always, starts with a humble beginning, with the help of family, friends, and the founder's own financial resources. That's how the humble beginning starts. But over time, its customer base begins to grow and the business begins to expand its operations and its aims. Before long, the company has risen through the ranks of its competitors to become highly valued, opening the possibilities for future expansion to include new offices, which means going global, employees, and even an IPO, which is initial public offering. So, what? So this is the journey and the dream of a startup founder, right? So, what are the funding options available for early stage? Because we're discussing about early stage venture. So, what are the different funding options available for an early stage startup? I'm going to start with Dr. Maren with that question.
Yeah, let me give you the perspective of entrepreneurs that I've been myself several times. So if you look at early stage, what we also call seed phases, and later there is then, no, first is the seed phase, and then we'll have the early stage and late stage and growth capital phase. In the very first beginning, many entrepreneurs, they go on bootstrapping. So they found themselves, or it's the family and friends who help them actually fund their business. So that's one category. The other one is, and that's still available and popular in certain jurisdictions, you can have a look at crowdfunding. There has been a lot of noise in crowdfunding. Funding. Well, Sonny, maybe you can chip in with some thoughts on that one too. Later on, there are the angel investors. They come a lot with mentoring along funds. And then we are actually at a junction towards early stage. And then you'll see a lot of accelerators, incubators. I'm also part of one, the German Accelerator program here in Singapore. We're helping German startups to scale in Southeast Asia and the other way around. And thereafter, it's the venture capital play at early stage. Venture capitalists are basically more active investors. They have expertise. Very often they've been entrepreneurs themselves, so they've been sitting on the other side of the table too, and they also chip in the network. From there, you'll see at a later stage many CVCs. That's the corporate venture capitalists. That's actually arms of larger corporations who do run co-innovation, look out for startups for their own strategic play, or purely as a financial investment. And then again later, you might see venture debt or even bank loans in some jurisdictions all over the world. So that's from the very early to the later stage to give you an overview of what's down there. It's very important actually to distinguish and understand who are you talking to. And there are also the family offices. The family offices, they can be a little bit everywhere. It really depends on the family office itself. I'm also talking for one, actually.
Thank you so much, Dr. Maren, for taking us through that journey. It's very important at an early stage, as you rightly said. Who are you talking to for that raising, for that funding? Gary, over to you, please.
Huh. Can you hear me?
Yes, very well.
Okay, good. Yeah, I mean, Dr. Schweitzer covered a lot of it. I mean, the situation is you got to go where you think you're going to get the most value for the money. And so, of course, family and fools, when you come in, I mean, it's risk capital, right? 9 out of 10 startups fail. So, coming into it, there's a high probability of failure, although there are ways to dramatically increase the probability of success. So, for me, I would look at who's really supportive of your idea and can really give you help, right, as an early stage investor. So that's like the Band of Angels in Silicon Valley. We have a super group there, or wherever, they're global, that can really give you the assistance, the idea, and direction to help make you successful. Of course, family and friends is always a first shot at the situation. And then your own, retirement. In the US, we have IRAs. And sometimes people take money out of their retirement account and invest. I mean, I've done it myself. You take it out, use your own money. If you believe in your dream, you do it.
Oh, wow, that's interesting to know. Thank you, Gary, for sharing those opening remarks. Next, I have Dr. Shrikant.
Um, See, when it comes to early stage investments, I believe there is a bit of an echo. Yes.
Yes.
When it comes to early stage investments, I believe the innovation angle, which was looked at quite heavily earlier, has only increased because of the fact that now I think we are in a setup where we know that the COVID exists, and we know that it is, it's become a part of our family, right? So
Yeah.
earlier we used to talk about startups which were using the COVID format to actually pivot themselves. Now we are talking about startups which have propelled themselves from the COVID and actually have matured what they could have achieved in 6 years in about 6 months. So I think from a propensity point of view, if I may bring in don my engineering hat, though I don't have any, I have a accountant hat and a legal hat. I think the fuel has got you till here. I think it's time to detach those propellers and possibly do the orbiting, right? I think the areas of investments have grown wider and wider, and the COVID has only opened up those opportunities. And now we are looking at, when we look at seed, I don't think we are looking at those humongous. I think somewhere the sanity has prevailed, and somewhere the investors have got a hold of what an early stage market looks like. I think even the startups are not being extravagant at the moment, is what I'm saying. Gary, I stand to be corrected. Maren, I stand to be connected if have made a factually incorrect statement. But I think the startups themselves have started realizing that asking these humongous or monstrous amounts in a seed round would actually backfire. So I think that's where there is a bit of a sanity which is prevailing, and that sanity is what is helping us as councils as well, because we're able to do that first level of check at the startup level itself. The startup itself is not coming forward and saying that, look, here's an investment. uh, I mean, if I may take another 30 seconds, I mean, I've been through a journey 10 years or 15 years back where somebody just came up to me and said that, look, I'm going to start something tomorrow. I'm going to start something. Is this an idea? Give me $1 million. I think that level of insanity has not I don't think we don't have anymore. And I don't know, I mean, Gary, I would like your thought. I mean, what I mean, you've always been adventurous, right? I mean, you've always loved people who take those risks and so on and so forth. I'm a risk averse person. To me, a person who doesn't possess that entrepreneurial spirit, or has that entrepreneurial spirit of risk taking, is normally preferred. Um, uh, but for a seed investment, you need to put in a lot of risk. The IRRs are crazy, and so on and so forth. So I don't know. I mean, from a trade perspective, what are we looking at right now? I am still risk averse. I'm still at a seed level. I'm still averse to ideas which are being repetitive, which have already addressed a particular market, and which exists. There are this too much players in that particular market. So, but again, the crazy lot is still there. I don't know if they are still approaching the VCs the way they used to approach, cold mails and so on and so forth. I don't know if they exist anymore, but I've seen lesser of them, primarily because of the fact that I would have marked them as spam and they would have landed in spam. I don't know, but I stand to be corrected.
I think that's a very good question coming from Dr. Srikant, both to Gary and Maren. So, are you going to be spending extravagantly for a seed stage of when a startup is at a seed stage? asking you for $1 million just with an idea in mind. I'm going to start with Gary.
We, my situation is, and I've done thousands of companies through my accelerator that I started in Russia, literally thousands, and also my corporate accelerator. So the one thing that you can do is if they have some of the right tools, part of it is think about it. Again, I'm a country boy from Pennsylvania, so I think about simple stuff. It's keep it simple, stupid. The thing is, most of the time the startups coming out have never, ever had this journey before.
Right.
And so they don't understand where to go. It's like driving down the road without having a GPS system or a navigator. You just don't know. And so a lot of it is give them guidance, learning by doing. So if you give them the toolkit to be able to do that, many times what happens is you'll see miraculous. I've seen it in my accelerator. We've run four cohorts, and I've seen the companies raise money. I've seen them get sold. One of them just got sold last week. So it's a matter of having those contacts, and it's the same. It's a bridge between those investors and the startups, and it's direction, product market fit, some of the basic stuff, MVP. Do they have sales? If they have sales and revenue, that changes the model a bit. Are they in areas like artificial intelligence or quantum computing? And where are they going to apply it? Is it farming 4.0 or where is it? And so what you find is the startups want to succeed for the most part, right? But some of them also want to be regional plays. They don't want to move out of Asia. They don't want to move out of the US. They want to be more of a lifestyle business. So you got to look at that. But the ones that have the heart and the grit, last week I had a show, and I met a guy who in 2007 was in his apartment in San Francisco, and people were laughing at his call center, the things that he wanted to do, and even his father. He was laughing. I know him, but anyhow, a week and a half ago, he sold his company for $14.7 billion to Zoom, and it's having the grit, having the belief in your dream, looking yourself in the mirror. So I think that you can have, Srikant was right. The first MBA program, it was at Harvard University. It was to teach managers how to manage, not how to be entrepreneurs. And risk is actually opposite of what you would have in a corporate life for the most part. They don't really want you to be risky, right? It's against it. So it's a different kind of breed. But at the same time, listen, if you support them, if you focus on it, if you give them the right direction, you can dramatically improve the success of that startup. It ain't easy. It's not easy at all, especially now with the third wave of COVID coming in.
Yeah.
The Delta. By the way, it's packed down here with Delta in the hospitals again.
Wow.
Yeah. So it's we see it all over the place. So yeah. But the good news is, it's been an opportunity for the last year and a half. Companies are still getting bought and funded. You need things like VCTV to get the word out and to talk to those investors.
Thank you, Gary, so much. I think I heard from Peter Plot as well that I think UK is also having that variant of COVID, including US. Well, life moves on, as you rightly said, Gary. Things are moving, and you are also involved in a SPAC and many other deals. So, just to address that question from Dr. Srikant, Maren, I'd like to take your perspective. Is it too risky to put your dollars into a very early stage startup with just a fantastic idea who are into the tech space, AI, just what Gary said? What's your take on that?
Yes, certainly you have to have a bigger risk appetite, and I think there's still a lot of dry powder out in the market ready for early stage and seed investments. For all entrepreneurs who are watching our show today, my advice is do some research. What is the family office really focusing on? What is the VC focusing on? What is the angel investor really focusing on? Not only sectors, but stages and so forth. So if we look at early stage companies, we evaluate a little bit differently than in later stage or growth capital firms, certainly. So it's the absolute opposite, honestly speaking. So if we look at growth capital investments, for sure, we look more at the EBITDA play. We look at how good is the order book, how does the management actually
Right.
manage the product portfolio down the road. That's not the case in early stage investments. Early stage investments, what's very important actually is to identify the peer group, go on peer group analysis, then look at a couple of metrics. Gary has mentioned them. So it's operational metrics, can be monthly recurrent revenue, can be average monthly users, also scaling options in respects to working capital or capital requirements. So these are the appropriate metrics. And from there, we move it to applying these metrics to 3 or 4 risk mitigation thoughts in our investment thesis to decide if you want to go for it or not. And yes, look out for accelerators, look out for family offices who help you fine tune your pitch, your thoughts, and also who mentor you to raise capital. And don't shop around everywhere. If you're in the Silicon Valley, there might be no need to talk to early stage VCs which are sitting around in Southeast Asia and vice versa. You know,
Right.
that might be just a waste of time, or it'll just end up in the spam folder, as we've heard before.
I think that's a great piece of advice. If you are in Silicon Valley, speak to the VCs within your sort of vicinity country. Okay, great. I'm going to drill down a bit into, sorry, let me just change my layout a little bit first. Okay, I'm going to drill down into the metrics, like we spoke about revenue, we spoke about what else? I'm going to talk a little bit about pitch deck as well, how important it is. But I just want to know, beyond this funding, how can VCs and family offices help these startups? Okay, funding is, yes, definitely is required. But there are other things that make us entrepreneurs successful, right? So, what are the other factors, and how can they sort of help this startup to grow and scale? I'm gonna start with Gary on this one.
Yeah, sure. I feel like the Hollywood squares here going around. uh, yeah, so it's if you look at it, I always look for strategic investors. Everybody that I want to be part of the team has some value. There's got to be some value. We have to be able to help one another. So I look at that. I mean, I've had the best VCs that I've ever had are ones that I feel are part of my team that really, call out and they want to do it because guess what? They have a lot of really good contacts. So do the Angels. Like Band of Angels in the Valley is one of the top bands in the world. And, they're mostly retired executives from companies. They're retired VCs, but they have incredible contacts. And, when it's all said and done, business is a contact sport and you need that network. Many times, from my standpoint, I find advisors that have degrees from places like Stanford University, MBAs. Why is that important? Because there's so much activity around entrepreneurship and technology that they have contacts. They can use your stanford.edu email address and reach out to people. But you need to, it's not just about the money. The money's the easiest thing. It's the
Yes.
contacts and connections that are the
Yes.
most important. So if you want to be successful, remember, business is a contact sport, and startups and entrepreneurs out there, make sure you manage your network properly. There's a book called "Business is a Contact Sport" by a guy named Gus Vierta. You should take a look at it because understand how the value of that network works and how that network can work for you and how you can help ensure that network keeps growing. So look for people that can help. It's not just about the money. And be sure the worst thing you can do is get dumb money. By dumb money, I've seen situations where somebody's raised money, like a real deal, where they raised money and 3 months later the person said, I want my money back and you've got to give me 1.5 times what I gave you. It's senseless. I mean, this is a startup, right? So they're trying to get their money back from a startup and they set unreasonable demands. So make sure that when you get the money that it's smart money, not dumb money.
On that note, Gary, I don't know if you've seen this Netflix series Startup. Have you seen it?
No.
Oh, okay. It's about the cryptocurrency. Zencoin. So we have this entrepreneur who's a lady, and she founded a token that's going to democratize the entire financial system. And obviously, then you see the investor who takes the source code, and sort of a lot of things happening. I mean, if you haven't seen it, please see it because whatever we're discussing here, they've sort of filmed it very nicely. So yeah, thank
No,
you.
I think there's a lot of up. Think about the world, how it's going to change. I mean, the way that we're doing things, I talk about inundated with data around us. I mean, think about it. It's worse today than it was 2 months ago when we talked, right? It's just we are inundated, and that's where there's a lot of opportunity. And the systems that we have in place today, like Facebook and Google, where we're giving our data away, we need to own the data and tokenize it. And the next movement's going to come around those kind of areas. I actually wrote in Forbes yesterday about it, like directly, because it's coming to the point where it's in front of us, and we need to do something.
All right. Thank you so much, Gary, for adding that on. Next, I have this question for Dr. Srikant. I'm sorry, I hear some noises, some technical glitches, but we'll try to sort this out. Dr. Srikant, how do VCs and family offices help beyond funding? Because funding obviously is the most important thing, but not the only important thing for a startup in their journey.
No, I think the most of the points have been covered already. The network that they bring is key. I mean, funding is just one part of it, right? So I've seen two spectrums of family as such. One family which puts in money, like Gary very rightly said, puts in the money and just behind you to pay back. And then you have a family which is an inclusive family, and what it basically does is it includes you in all the further investments that it does and helps you synergize. So I think it depends on how efficient that family office is. Choose your money smartly from a family office. I mean, this would be the advice that I would give to startups. Look at the portfolio and choose the right family office when you're choosing a family office as such for your seed money, primarily because of the fact that a family office which gives you basically a debt which gets converted, or a debt which is repayable immediately, and so on and so forth, which doesn't have the synergy with you, but which is just putting the money just because you've sold them an idea, or you wouldn't have done anything. I mean, trust me, you have the startups have very little information about what goes on in the background. Gary and Maren will agree with me on this particular part, at least. When the investment goes through the check, it's about how the family decides and how the family family, during a conversation that they had in a bar with another billionaire family. The another billionaire family basically said, look, this particular investment is good, and they made the investment. It wouldn't have been what you sold to them. It would have been somebody else who would have basically said, go ahead with this particular investment. So I would rather say evaluate your money, evaluate the dollar that is coming in a little more closely. Don't dilute your holdings. As and when money comes in, there is one thing that startups still they err in the decision making. They still make an error in accepting whatever money that comes in, which may be actually derailing their entire business.
All right. Thank you so much, Dr. Srikant. So I just want to ask another question, which is in continuation with what all of you said. We have two representative of, we have one family office, one representative of family office, and Gary obviously is venture into VC. So for a early stage startup, what's the right, uh, how to put it, which place to go? Which is the right investment? Is it private equity? Is it venture capital? Is it angel? Is it family offices? Because there are so many options available. in the market out there, right? It's kind of overwhelming, right? With that information that is there. So, as for you and for your experience, for an early stage startup who just managed to bootstrap itself, what's the right investment uh, model to choose from all these available financing options available in the market? I'm going to start with Maren.
Yeah, my advice to all startups is to look behind money, because the value of whoever entity it is, may it be a family office, may it be a VC, may it be an angel investor, may it be a CVC, whoever, whatever name tag is on it and what background is, I suggest look beyond the capital in three categories and ask yourself what's the value. It's in expertise. One, it's two in mentorship, and it's three in network. And try to keep them pretty much separate, not to get a pudding or pie out of it. You know. So what is expertise about? It's about the investor's entity. I'll just call it investor's entity. Can be VC, can be a family office. It's the skill set. How well do they know the industry you are operating in, and if you are planning on a go-to-market or internationalization, how well do they know the region and the local market drivers? That's the expertise part of it. The second one is ask yourself, how much do I get mentorship from my investors? And here you should ask yourself the questions, are my investors also entrepreneurs or have been entrepreneurs themselves? Do they have long-standing legacy businesses in their background? Do they also have startups? Do they have overall experience in being an entrepreneur with all the ups and downs? That's the mentorship part. And the more experience they have, the more they'll be very valuable mentors. And thirdly, and it's also very important, it's the network. So network has various aspects. It can help you to recruit the right talents to help you thrive. It can also open doors for subsequent funding rounds. I'll come to that later in our show today. And also, what's the potential of synergies to other portfolio companies your investors have in their own portfolio? And you should also ask yourself in the networking aspect, can they open doors to potential customers and also suppliers for your venture? So it's expertise, it's mentorship and network. So all the value is far beyond capital.
Absolutely.
And don't forget the family offices, because sometimes they go undercover because they are not so present in the investor space.
All right. Thank you so much. I just want to ask Gary this question. Family offices, talking about family offices. Do you think, Gary, it's easier for a startup to approach a family office or just go VCs, shopping for VCs? But what I know that VCs obviously take a large chunk of your business as opposed to a family office. Maybe they might be conservative, but they are holding the billions, and once they like you forever. For VC mentality is not like a family mentality. So what do you think for early stage startup?
Yeah, I mean, the situation from my perspective, it really depends on what kind of, if you've tapped into that family office environment and you've either have your own family office or part of it, or you're connect. If it's an early stage startup, do they have some ins into the family? It's not easy because there are very few lists that talk about the family offices. And if you try getting in and people don't know you, you're not going to get in. It's like dealing with any ultra or high net worth individuals. It's hard. You just can't come in because they're suspicious. You got to have some type of a trusted way in to be able to meet with them. And then if you do that, the family offices are really good. VCs, on the other hand, I mean, like Venrock is the Rockefeller, the venture arm of the Rockefeller family, right? So there's a lot of the family offices, a lot of the VCs, if you look inside of them, have ultra high net worth families behind them. It's really interesting. So you got to make a determination. What do you really want, right? Family offices are really good to deal with if you have the in. VCs are really difficult unless you have an in too, which means if you just send somebody your deck the probability that they're going to really look at it is very small, right? It's not going to happen. You have to have a trusted way in through a referral. So if you know
Right.
somebody that's a VC and they give you a referral in, the probability dramatically goes up. They're going to take a look at it because they're inundated. They get hundreds, thousands of decks, and they just don't have time. Then you got to do your research, figure out who that person is, what they like to invest in, and it's sales. You really got to customize whatever notes you send based on their particular personality, their particular investing strategy. For instance, if you find out they've graduated from Harvard or Oxford or Stanford, find a friend that's graduated from one of those schools that can use their .edu email address to get to them, because the probability is really high they're going to look at it.
Right. Absolutely. Thank you so much, Gary, for adding those on. I'm going to ask Dr. Srikant after this. So, Dr. Srikant, what's the appetite of family offices as per your experience, the ones that you work with? Is it like early stage startups? They want to sort of invest into and see them grow into a growth stage, or maybe going public. I don't know if that's what they're aiming for. But what generally do you see within your sphere of work?
So I may be criticized a lot if for making this particular statement. But family offices themselves are finding it tough to to have a level of efficiency amongst themselves, right? I mean, family offices themselves are not evolved, at least over here in India, in emerging markets, they're not evolved enough to handle the emerging or the the trends that come out of a particular industry. So somebody, like I said, I would double down on what I said earlier. Somebody would have told them in a dinner conversation that, look, crypto is a great asset, and they would have, I mean, they come back to me and ask me, what do you think about crypto? And I give them a statement, and they basically go back to that person and ask them, how much money did you make? And this is how the conversation goes. So it's not a very focused setup in a family office perspective. But there are many family offices which have emerged from this particular quagmire of leads that come through these dinner conversations. They are more, I would say, advanced family offices, and these are where you have the deal pipeline and so on and so forth. So I would say the family offices are great for early stage because of the fact that they're easy to connect to, and
Right.
not easy to connect to from a email point of view, but easy to connect to from a emotional point of view, right? They would experience the same journey that you would have experienced as an entrepreneur, whereas a VC would have had a different experience altogether. They may be answerable to someone else. So I think from an emotional point of view, they're more accessible. I think there are a lot of checkpoints in a family office, but once you get through that particular checkpoints, once you're in for life. So it's like a tenured job. A family office is always a tenured investment. So you're in them for life. So they'll not forget. So that has been my experience with family offices. At least they're very grateful. They're very appreciative of good returns that accumulate their way, and they'll pass on leads as such. But the VCs may not. The VCs may have a different mandate altogether. So to me, the family office is always ranked first in terms of investment opportunity.
Thank you so much. I love those insights, actually. I don't know, for some reason, I just love working with our family offices. I work with VC. Sorry, guy, don't get me wrong. We have Dr. Maren, we have Dr. Srikant, then we have Karthik as well. So yeah, so that's just. But yeah, so let's just come over to early stage startups now. Sorry, I mean my personal favorite doesn't matter right now. Sorry. Coming over to VCs, how does VC evaluate? Let's just focus on VCs. how do they evaluate these investments? The reason I asked, I think Gary just touched upon a few things. So did Maren. A founding team, minimal viable product, customers, which is sales. What about return? What about the business structure itself? What about exit strategy? So let's just discuss some of the factors that a VC evaluates before investing. Dr. Marin, let's start with you.
I believe that both family offices and VCs are looking at similar metrics, whatever stage of investments we are talking about. But we have to keep in mind the business model is very different. VCs are often run in closed-end funds, so it's a 10 plus 1 plus 1 years tenor. They have their LPs, their investors who chip in the money, and then they have to invest, grow, and sell. So there is the pressure to exit, which is, with family office, in most cases, not the same ballpark. If it takes longer, it's fine. So they are more open to doing syndicate deals, stay longer with the startup, see how it's going to develop, and then probably just wait and mentor and help. But the metrics are the same. So it's basically the metrics of the business itself. We're always looking at operational metrics. Gary has mentioned some before. So in digital businesses, it's a lot about average monthly users, recurrent revenue models. How good can you bundle your recurrent revenue models and make it to a bundle? Bundle plus recurrent revenue model, we call it bundle internally. Then for sure, if you app play, it's the number of downloads. And then a couple of operational considerations. So customer acquisition cost is something we're always looking into it. How much money do you need to spend to get a customer? What's the retention rate? What's your burn rate? What are the headcounts? Yeah. What are your capital requirements? CAPEX, if you have to do investments, and also OPEX. Because that's the question, how well can you scale and how much capital do you require to do so if you've identified the market drivers and have a successful value proposition. What's also important, and don't forget that, it's about the peer group. That's what all investors look. They look at who's out there too and how can we compare them. And then it's the peer group analysis, it's the corporate metrics, and then also the third part is what value can we chip into the startup to make it more successful than it would be without us. So that's what also Gary mentioned in the beginning of our show today. That's very, very important.
Thank you for re-emphasizing on these points. I think it's very crucial for startups and entrepreneurs out there to understand the importance of these metrics before approaching any investor or any sort of investment, seeking out for any sort of investment. Because I remember from one of the sessions, Kingsley mentioned somebody wrote to him on LinkedIn asking for money without even an introduction. So don't do that. So Gary, would you like to add something to how VC sort of evaluates before making an investment? What are other metrics? If Maren has covered all of them, so maybe we just...
Yeah, I mean, the first number one is the team, right? Does the team really have the right stuff, the grit to be able to get the job done? Especially in the early stage, because you are looking at the metrics to make sure they meet the metrics. But do they have the, we look at number two is, do they have the capability of going global? Because that's really, if you want to create $1 billion company, you gotta have people that think differently, that really want to change the world, that really want to dominate a specific space. Some people talk about it, but they're just, they're not there. So we look at that capability, and we also use Silicon Valley as a port to the rest of the world, because if you look at it, there's so much capital there. There's so many family offices there. There's so many companies that have, for instance, Bosch, right? Intel, Siemens, just across the board, they have innovation offices there where they're looking for opportunities. And for me, it's like fishing. When I was a kid and coming out of the farm, you wanted to go to the pond that had the fish in it. So for me, I want to look for the fish. So if I was a startup, I would say, how do I spend the least amount of money and get the most impact? And where can I do it and how can I do it? So, I'm looking at those forward thinking individuals. I'm looking also for diverse companies. So we focus a lot on intergenerational, culture diverse, decentralized teams to be able to maximize opportunity. Because, if you got to make sure there are enough, males, females, people of
Right.
color on the team to be able to make a difference, and culturally different too, because you want to be able to look at the problem in the different ways. Also, intergenerational teams. We have people that have some of the gray hair, not just the 20-some-year-olds, because you need that experience to really help drive it forward, especially today with the pandemic and the challenges you have of not being able to meet in person. You need to have credibility. And many times, those kind of folks, whether they're advisors or board directors, can help you with the contacts and help with the credibility.
Absolutely. Thank you so much, Gauri, Dr. Maren, Dr. Srikant. I just want to touch base on one little topic which keeps on coming up whenever we are talking to investors, we're talking to entrepreneurs, the term sheet, right? So just want to end my session with this focus area, term sheet. So what is a term sheet and what are the best practices for doing one? I'm going to start with Dr. Srikant.
Yeah, you want to start with a legal perspective, right? Because the term sheet is a legal document, and
Yes.
having seen yeah, thousands of them possibly. What I would say is there are these there are these suicidal clauses that you shouldn't sign up to, and a term sheet with a clause which will basically say hatchet. In legal we call it hatchet clause or so on and so forth. So think twice before signing something up. Once you've signed a term sheet, it is a signed document. It is a contract. You're obligated by the contract. So what happens is you've signed up. Then don't ever sign a term sheet that you're going to regret. So if you're asking me a question as to what term sheet is basically a contract which says that yes, I'm interested in your startup and formalizing the intent of investing in a startup in a particular format, and also specifying as to what return that I expect from this particular investment. So in the if you make a hurried investment, and you could go wrong on both sides. You could go wrong from a VC perspective, or you could go wrong from a investee perspective. So investee may sign up a term sheet which will give them a 5x liquidation preference, which is basically suicidal in my thought. And then you have other clauses as well that you need to sieve through. So always consult, consult, consult. Don't ever leave a term sheet open without. Don't sign a term sheet without consulting.
Yeah, I totally agree with what you said. Sorry, I think I'm just concerned about the time. Dr. Maren, let's take your perspective.
Yeah, it's really very important. That would be my advice. If you have a term sheet in your inbox, get yourself help. If it's the first one or the second one you see, go and reach out to legal counsels who are in the VC investment space, or reach out to friendly VCs who don't want to invest into your company, but they should be from the same region, because jurisdictions are very different, to help you advise on what you should look at. Don't rush. So basically, what do term sheets frame?
Yeah.
It's two topics basically. It's how you split economics, and all about, and that's the second topic. It's monitoring and control. So let me give you a couple of examples. Splitting the economics. It's basically the price per share and the valuation. It's how do we liquidate together. Sometimes investors agree with their startups that there's a tag-along clause. That's an example. Tag along would mean if the minority stake VC wants to exit, you have to exit with them. At that valuation, normally you need to look at anti-dilution clauses and a lot of other things. Monitoring and control is more about board composition, protective provisions, and the drag along I mentioned. So these are the two things. And please take your time and take into account and get yourself help in the shoulder before you enter into term sheets. It's a very important document because it's tailoring your partnership down the road.
Absolutely. Thank you so much, Dr. Maren. Gary?
Can you hear me?
Yes, we do.
Yeah. So in terms of the term sheet, it just sets everybody's expectations of what you're going to have in that relationship, the kind of relationship you're going to have, and what the expectations are. So for me, it's just making sure everybody's on the same page. Of course, there's many legal ramifications, etc. But it's basically line it up so we all set our expectations and we're all on the same page. So there aren't questions later.
All right. Okay, cool. So thank you so much. I think Gary was very to the point. Specific. Let's take some closing thoughts before we wrap up the show. So let's start with Gary then.
Yeah. So this is a great time, with all the, for the last almost year and a half, over a year and a half, the pandemic. What's happened is companies that are out there, make sure you have a good visibility. Make sure you're writing articles. Make sure you're speaking. Make sure you got visibility, because as soon as you get on that call with that VC today, they're going to check your name on the web. They're going to check. Make sure you have some content out there so they can look at it. It'll dramatically help you with that relationship with that VC or family office. So produce that content, get it out there. These are great times for the companies that are smart. These are great times to go global. The digital transformation has really brought us ahead 10 years from where we would have been. So use it wisely. Get out, go to the pitching competitions, go online. You can save a lot of money and you can reach a lot of people. So go out and do it. You can reach me, Gary Fowler, on LinkedIn. You can reach me on Twitter. Check out my shows every day. I've got different shows. Check them out. It'd be great to have you there, and stay happy, stay focused, and keep smiling.
Thank you so much. Thank you so much, Gary. Thanks a lot. Dr. Srikant, let's take your closing thoughts.
Um, yeah. So my closing thoughts are this. I mean, I would double down on what Gary and Maren said, and I would say that this is a great time to actually start exploring. I think the COVID has done, of course. I mean, rest in peace, all the souls that we have lost and all the COVID warriors. But it has brought in a lot of good things as well. It's a bittersweet moment, indeed, and this is a moment that you could pivot and you could reason your pivot. So I think COVID has brought that perspective as to how you can reason your pivot. Take that into account. Don't be complacent, and don't put everything on COVID like you used to 6 months back. I think we as investors we have kind of gotten used to everyone saying that, look, it is a COVID impact, blah blah blah, and so on and so forth. So COVID is not going to help you anymore. So move away from the COVID shield that you had. I think we are looking for smart companies, and at the same time, we should be looking for smart investors. So if an investor is investing in you just because you are a COVID positive company, the company which has made a positive turn because of COVID, I'm not a smart investor, so you don't want me.
Sorry, was that so? Basically, did I understand that clearly? If a startup has pivoted,
So
you are
the
not.
startup is pivoted, and I'm investing solely because of the fact that they are COVID positive company. I'm not. I'm not a smart investor. You don't want my money. It may be good in the short run, but it may not yield you the benefits in the long run, because smart investors are now investing in something beyond COVID. That would be my perspective.
Interesting perspective. Thank you so much.
Controversial, but yeah.
Dr. Maren?
I have very similar thoughts. Please stop talking about COVID. I'm hearing a lot of pitches with, oh yeah, we couldn't pursue our business plan, and we crashed a couple of milestones because it's so difficult with COVID. That's the new normal. Stop saying that, would be my advice. Secondly, what Gary mentioned, I need to underline it. Don't go in stealth mode too long. Get your visibility up. Work on personal branding and get everything consistent. Your LinkedIn profile has to fit to your pitch, and so forth and so forth. Any inconsistency will be discovered, because that's what we do as investors. We go beyond and look what's out there. And don't forget, internally, the culture is the secret sauce. So despite you have to spend a lot of time in fundraising or pivoting in these times, spare enough time to nurture your own culture. Never forget, in times of crisis, you have to over communicate with your employees. That would be my advice, and it's also my closing remark.
Thank you. Thanks a lot, Dr. Srikant, Dr. Maren, and Gary, for sharing your insights today about early stage venture and seed investments. Very insightful session today. And I'll be back again on another episode of VCTV with, of course, you all, and on a new topic. Till then, as Gary always says, stay happy and keep smiling. Take care. Bye.